What do you think will happen? And also, I want to talk to you about that statement, highly attentive. Does it matter to you if they repeat highly attentive or just say attentive? We had the Morgan Stanley chief U.S. economist saying that word highly could be a market mover.
Absolutely, Frank. This is very important. I mean, the Fed has been raising rates 550 basis points in total up to this point. And the question for them still is this enough? And looking ahead, that dots, meaning the chart that tells you something about what they will do in the future, are already showing that a lot of cuts, 2 percentage points of cuts, are coming over the next few years. So the key issue today will be, what is the communication about the future? Do they feel that we have reached a path where inflation is moving down towards 2? Do they also feel that the other side of the dual mandate, namely full employment also being is achieved? So the conclusion to your question is that they will today continue to signal hawkishness. They will continue to signal that they are worried, because if they don't say any change, if they just stick to the current path, then it will be a risk that the market will begin to think about what type of economy is it that will be required to generate the more than 2% cuts that they have in their forecast. So their communication about what's coming over even the next several quarters is going to be very, very important.
Okay, so you're actually looking at inflation, but we generally look at it as one big number, but you're looking at goods inflation and services inflation. You sent us a chart, so we're going to look at that data right now. So you're saying goods inflation is moderating back to pre-pandemic levels, but services inflation is a different story. Does that differentiation, does that really matter to the Fed, in your opinion?
It does matter, because remember, 80% of the economy is services. We always tend to, all of us, think about, well, inflation, that's what I buy in a store and that's what I have in my basket of goods. But the reality is that that basket only makes up roughly 20% of your overall spending. So if 80% of the spending is still quite elevated, in particular core PCE and also super core PCE, which is core inflation excluding housing, is still very elevated. And the problem for the Fed is that if we are still well above their 2% target on those measures, on core, we're at 4.3, on super core, we're 4.7. And if those measures still are around 4.5, and we should be at 2, the challenge for them is then, can you get that slowdown in the economy without slowing the service sector? And the service sector is still red hot. People are still flying on airplanes, going to restaurants, staying at hotels, going to sporting events, concerts. We saw Taylor Swift tickets, US Open tickets here in New York City were very expensive. All that becomes very relevant when you think about, can you get inflation down if those sectors of the economy are still red hot? And that's what they need to address today, namely, yes, goods has been resolved, but now services, consumer services, everything we go and enjoy after the pandemic is still quite hot. And that's the challenge that we also need to see the Fed's view on. That probably also needs to come down closer to 2%.
Torsten, it's hard not to chuckle when people continue to talk about Taylor Swift's impact on the U.S. economy.
I'm sorry about that.
But over to more serious matters, is the Fed also paying attention to labor negotiations, whether it's the Teamsters deal with UPS, the pending negotiations with the UAW and the automakers? Is that important to their decision? Do they look at that as far as wage inflation?
Yeah, we have that. Because remember, services, when you go to a restaurant, a very key input in the price, what you pay, is the cost of labor. So that means that wage inflation, which is still quite elevated, average hourly earnings, which is the wage number that comes out of the employment report, is still 4.3. And again, before the pandemic, average hourly earnings was between 2 and 3. So from that perspective, Frank, it's correct to say that, yeah, the service sector is actually driven to a large degree also by what's happening on the labor front. And exactly to the point about the UAW strike, and even also the issues with the shutdown, that also becomes quite important. It may not matter if it's all temporary, but the longer these things last, it might begin to have some ripple effects. And they might also begin to have some more permanent effects, including on wages. So it does become very important for the Fed to try to assess these very difficult to quantify factors that are the strike and also, again, the shutdown that might or might not be coming, in terms of how should they turn more hawkish now? That might be a risk. Should they turn more dovish? Because that also might come with some risks.